Welcome to the next session on commodity derivatives and risk management. In this session, we will discuss different aspects of commodity options, and one thing I would like to highlight here is that the commodity options normally have commodity futures as the underlying, not the underlying goods. Also in Indian exchanges, commodity options are yet to be traded. However, majority of international exchanges such as LME and CME, Singapore exchange, CIMEX, etc., we have commodity options with commodity futures as underlying. Now let's before we go to understand the contract specification of commodity options, let's understand or let's revisit what is our understanding on four different options, that is long call, short call, long put and short put. I will give the example of this as if the options have the commodities as underlying, and from there we will take it up how the settlement will happen when the futures are as underlying. Now let's go to our understanding of options. So when a trader takes a long call or long put or short call, short put option, let's say a cotton producer, so CP, fears that the price is going to be volatile, cotton price may go down, may go up, he is not very sure of it. So he would like to buy a option contract where if he chooses to exercise the option, he will be able to sell cotton at a fixed price. Let's say, so in this case cotton producer will take a long put option. So by taking a long put option, he has right to sell. So let's say he takes long put right to sell. So again on 1st May 2016, he takes October 2016 option contract at a price of, let's say, 17,700 per pair. So this is going to be our, we know this is going to be our exercise price, we term it as X. Now when the cotton producer is taking a long put option, somebody has to take a short put and the cotton producer has to pay a premium. So it has to pay a put premium. Let's say put premium is rupees 100. So on October 26 contract, when the contract matures, let's say this is a European contract. So European option. So European option means cotton producer will be able to exercise the contract only on the maturity date. So being a European option, let's say 28th of October is the contract maturity date. So the long put option holder may exercise, may not exercise, depending upon the prevailing price on the exercise date. Now let's say on 28th October, the cotton spot price is, let's say 17,500. Now my question to all of you is that whether this cotton producer will exercise the option contract or not, whether he will exercise the right to sell. Long put means he has bought, but what he has bought is the right to sell. So the answer to this question is that of course definitely he is going to exercise, because without this contract, if he goes to the market, he will be able to sell it at 17,500. With the contract, it will be able to sell it at 17,700. Now, if we draw a payoff diagram, so any price, so this is going to be our 17,700. This is going to be 17,600. So this any price less than 17,700. Let's say the spot price is 17,699. Will he exercise? Yes, he will exercise, because if he goes to the spot market, he will be able to sell it at this price, but with the option contract he will be able to sell it at a higher price of 1 rupee. So any price less than this label he will exercise, but he will start making profit from this price onwards. So this is the payoff for long put option holder. And as we know, option contracts are zero sum game. So what would be the payoff for? So this is my 0, this is the label of minus 100. So what will be the payoff for the counterparty short put? So lack of space, please ignore. So this is going to be, so you will have, this is the 17,700, this is 17,600. So this is the payoff for short put option holder. So as we know, zero sum game. So the when at a price of, let's say at a price of 17,500, this party will gain, long put option will gain 100 rupees benefit after adjusting for the premium, and this party will lose 100 rupees after adjusting from the premium receipt. Now let's go back to payoff for the long call or long call and short call options. Now let's say a bread manufacturer buys wheat, and it fears that wheat price may go up or go down, or wheat price is supposed to may exhibit high volatility. If price goes down, he will be very happy. If price goes up, he will be unhappy. So to take a insurance against this risk, it may enter into a long call to buy wheat. So buy wheat for, let's say it enters into a long call option. What price? The exercise price is 18 rupees. For taking this exercise, it pays a call premium of let's say 2 rupees. Now expiry date is, let's say, 1 month from today. Now on the expiry date, being an European option, on the expiry date, what will be his action, that is whether he will exercise this right to buy or not. Now let's take different price. Let's say in the prevailing spot market on expiry date, the spot price prevailing on expiry date is 17 rupees. Will he exercise? Will he exercise his long call? No, he will not exercise, because if he goes to the open market, he will be able to buy wheat at 17 rupees, but if he goes to his counterparty, he will be able to buy wheat at 18 rupees. So, he will not exercise and he will forego his right to buy from the counterparty. Now, let us say the spot price prevailing on the exercise date is 18 rupee 50 paisa. Will he exercise? Yes, he will exercise the contract. So, what will be his payoff? So this axis is the different spot prices. So, any price up to 18 he will not exercise, but any price after 18, so this is your 18 rupees, this is your 20 rupees. So, any price after 18 rupees, the long call will exercise its option, and any price after 20 he will start making profit from the long call. Who is a counterparty? Counterparty is a short call. Again the same concept is applied here. So, both short call has a mirror image. So, up to if the price is less than 18 rupees, his benefit is going to be 2 rupees a kg. Any price higher than this, he will be earning less than that. So, any price higher than 20 rupees, he will start incurring loss. Let us say prevailing market price is 22 rupees. If prevailing market price is 22 rupees, the long call option holder will exercise its option, buy wheat from the short call party at 18 rupees. So, what is going to be the loss for this party? Sorry, the gain for this party will be 2 rupees, profit for this, and loss for this party will be 2 rupees. So, this is the payoff for short call. So, this brings to a concept called in the money, out of money, and at the money. So, what is a in the money? In the money means it is beneficial when we talk an option as a in the money. It is beneficial for long position holder to exercise. So, when we are talking about in the money, we have at the money and you have out of money. So, we have call option here, we have a put option. So, when it will be in the money? When the spot price prevailing on the expiry is greater than the exercise price. As spot price prevailing on the expiry is less than the exercise price, then the put option will exercise. For call, when the spot price is higher than exercise, the buyer will exercise and buy the underlying at a price of X. When ST is equal to X or closer to, very near to X, it will be called as at the money option. When it will be called in the money, sorry, out of money, ST is less than X and ST is greater than X. Now, let us go to our understanding on options on futures. So, when we are talking that commodity options have futures as a underlying, when an option is going to be in the money. So, when the in place of a ST, it is not the spot price of the underlying, we replace it with FT, that is futures price prevailing on the option expiry date if it is greater than the exercise price, then it will be an in the money and the long call option holder will exercise. Similarly, for in case of a put option, when FT futures price prevailing on that day is less than the exercise price, then it will become a in the money put option and the owner of the put option, that is long put option holder, will be able to exercise. Now, let us go to our, so this is, let me take you to this link, please see this one. This is the wheat option contract offered by CME, that is Chicago Mercantile Exchange, and please see this one. What is the underlying? Underlying is not wheat, but underlying is wheat futures. So, it is also very clearly what is the contract unit. Contract unit is the wheat futures contract for 5,000 bushels. So, these are the different standardization and different aspects which are given. So, this link will be available to you. So, you can spend some time understanding more about this option contract, but what I am driving here, or what I want all of you to focus, is that this contract does not have wheat as an underlying, but it has a wheat futures as underlying. Now, so as I discussed, when the long call or long put position holder exercises the in the money options, they take positions in the futures contract. So, when long call position holder exercises, he takes the long futures position, and simultaneously the short call, whoever is a counterparty to long call, he takes the short futures position. Similarly, you have a long put position holder, when he exercises, that party exercises, the party takes the short futures position, and short put position holder takes a long futures position. So, once the option contract expires, so now nobody will be holding option contract. So, long call, short call, long put, short put position holders now will have either long futures or short futures, depending upon what position earlier they had taken. So, this is all about commodity options. But however, as I said that not all exchanges have commodity futures as underlying. You have very few. You have, I'll just give an example at TIFEX. So, you have at TIFEX options on gold, and the underlying is gold and not gold futures. Underlying, as mentioned here, the underlying is gold and gold and not gold futures, but it is not very common. Most of the commodity exchanges have futures as an underlying, and in India right now there is a considerable amount of debate going on whether we should have options, commodity options with commodity futures as underlying, or actual commodities as underlying. Now, let us go to the next type of contracts which commonly trades at an exchange. So, this is called commodity spreads. So, what exactly is a commodity spread? Commodity spread is that simultaneously a buyer takes position in two futures contract. So, let us take a simple example of a calendar spread. Calendar spread means somebody can take long futures position in a near month contract and simultaneously sell a futures contract that is takes a short futures contract in a far month contract, or vice versa. So when you have somebody takes a calendar spread and he is taking a buy spread, he takes a long position in a far month futures contract and short position in a near month contract. Similarly, you can have in the sell spread contract, you have a short position for far month futures contract and long position for near month contract. So in India we have calendar spreads available. So this particular link shows the the spread orders which are available to which a trader can take. As I mentioned, buy spread means buy the far month and sell the near month. Sell spread means sell the far month and buy the near month. So depending upon how the futures price, what is the movement between the future price of near month, far month, a trader can either buy a spread contract or sell a spread contract. More about this spread contract and how this order can be placed, all these details are available in this particular link, and you can spend some time understanding more about it. Besides the calendar spread, many exchanges also offer intercommodity spreads. So what are these intercommodity spreads? You can have crack spread, you can have cross spread, you can have dark spread, you can have a spark spread. So what do you mean by crack spread? So somebody can buy the crude oil futures contract and simultaneously sell refined futures contract, that is refined product futures contract, that is futures contract on petrol, diesel and aviation turbine fuel or kerosene, whatever it is. So simultaneously somebody takes long futures in crude oil and takes short futures in refined product, or vice versa. So these kind of contracts are called crack spread. Cross spread, somebody can take long futures in soybean and short futures in the derived product, that is soya meal and soya oil. So or vice versa, that is also known as a cross spread. Dark spread, so buying and selling coal and electricity futures. Spark spread, buying and selling natural gas and electricity futures. In India we do not have electricity futures available. Also coal futures, to my knowledge, coal futures also we don't have coal futures listed in any of the commodity exchanges. So traders cannot take benefit of these two spreads. However, traders can take benefit of crack spread and cross spread. Now at this point of time, I would like to elaborate little more on what is the difference between a hedger, speculator and a arbitrager. Many times we use the word hedger, we use the word speculator. We have also heard people saying that speculation is equal to gambling, and speculation is bad for market. So many kinds of things you may have heard people saying, but what is the meaning of, or who is a hedger and who is a speculator and who is an arbitrager? Let's understand a little more. So who is a hedger? Hedger has to have a exposure to the underlying market. Let's say a cotton producer is fearing that cotton price is going down and he would like to mitigate that risk by entering into a short futures contract or long put option. So in that case, that trader will be treated as a hedger. Suppose the counterparty to this particular long the cotton producer is a bank or financial institution, or for that matter it could be me or you, an individual trader. In that case, that particular counterparty is going to be a speculator, because that party does not have anything to do with the underlying asset. So who is a hedger? Hedger could be a producer of commodity, hedger could be an end consumer of a commodity, or hedger could be a trader or wholesaler or a processor or refiner. So, when a producer is always long an asset, producer is continuously producing the commodity, and what is the producer's fear? That price will go down. So, that producer will be able to mitigate the risk by entering into short futures contract or long put option. Now, similarly, end consumer, let us say a bread manufacturer, as I mentioned just now, a bread manufacturer which buys wheat. So, what is that company's fear? That company's fear is that wheat price is going to go up. So, what it will do? It will be able to enter into a long futures contract or a long call option on wheat. Now, besides this producers and consumer, you can also have many other value chain partners. So, they can be, let us say, they can be a trader or wholesaler, so or a processor, refiners, etc. They may be long on underlying asset or short on underlying asset. So, let us take an example of a, let us say, a wholesaler, like let us say a wholesaler of a cotton. So, a wholesaler of a cotton, as of today, let us say it is not owning any cotton bales, but it has already agreed to sell some cotton bales at a fixed price. It will be delivering cotton bales at a future date, but the price negotiation has already happened. Now, in the meantime, if the cotton bale price increases and he has to pay a higher price for that, so his input cost goes down, but his revenue is already fixed. So, in that case his margin will go down. So, in this case the wholesaler will be having a net short position in the underlying. So, how he will mitigate this risk? He will be able to mitigate this net short position in the underlying market by entering into a long futures position. So, he will be entering into a long futures position. If price increases, he is going to he will be incurring loss. So, he will be entering into long futures position. Similarly, suppose the wholesaler has already bought the cotton bales and he is anticipating prices are going to go down if he does not do anything, and when he goes and sells the cotton bales, he will be earning less amount of money. So, how he will mitigate that risk? So, he already has a long position in the underlying, he will be able to mitigate by entering into the short futures position. So, these value chain partners other than the producers and consumers of commodity, they can be they can have a long position in the underlying or short position on the underlying, net long or net short position on the underlying, and accordingly they will be able to mitigate by taking futures or options contract. So, as I mentioned, who is a hedger? Hedger has to have a exposure to the underlying. And who is a short hedger? Short hedger is a party who owns the asset, who is already owning the asset or long on the asset, and he will be able to mitigate that risk by entering into a short position. So, your producers will be short hedgers, and who will be long hedger? A consumer who does not have the underlying asset with him, and what is his fear? Price is going to rise. So, he takes a long futures position or long call option to mitigate that risk. Then that time it will be known as a long hedger. Now, who is a arbitrager? Arbitrager, all of us we know, who make a risk-less profit by buying and selling simultaneously. So, a arbitrager has to buy and sell the two different contracts at a given point of time. Let me give you one example of an intermarket arbitrage. So, what is exactly an intermarket arbitrage? intermarket arbitrage is, let's say the gold futures contracts is trading at CME, and gold futures contract in dollar terms is also trading at Dubai Gold Exchange. We also have gold futures, but it is not denominated in dollar terms, it is denominated in INR terms, rupee terms. So let's say a trader who feels that these two price, there can be a some difference in prices of the futures contract trading at Dubai Exchange and Chicago Mercantile Exchange. He can buy and sell, he can take futures in one exchange and take long futures and take short futures in other exchange, and from the price differences he can get some benefit. You can also have something called a spot futures arbitrage. So in case of a spot futures arbitrage, you will have the spot, here I would like to mention that the spot and futures price move in tandem, because futures price derives its value from the spot price. So you cannot have spot price and futures price deviating from each other for a long period of time. So if there is some mispricing has happened, so arbitrageurs will be able to do cash and carry arbitrage or reverse cash and carry arbitrage. These two aspects we will discuss in the next session. So the arbitrageurs will be able to take arbitrage benefit if spot and futures prices deviate from each other significantly. Now, who is a speculator? Speculator has nothing to do with the underlying commodity. They take risk, they form a view about what is going to be the futures price, and accordingly they take a buy or sell position, they take long futures position or short futures position. They do not deal with the underlying commodity in any manner. Like let's say if I today take a I start trading in commodity derivatives, so my trading will be treated as a speculator, because I do not my day-to-day business does not require me to get exposed to price risk in a significant manner. Of course, my consumption of sugar per month is 3 to 4 kg, and sugar prices increases, and I will end up spending more. Yes, if I can go to the exchange and I can mitigate that risk, I can take a position of futures contract on 3 to 4 kgs of sugar, then only I will be treated as a hedger. Otherwise, if I enter into a futures contract on sugar, I will be treated as a speculator. Now, question is, do we need speculator? The answer to this question is yes, we need speculator, because we can have some situation where the speculator's presence is absolutely necessary. I will give two examples here. Suppose the commodity prices have fallen significantly, and there are many consumers who would like to take long hedge position to lock in the lesser price. They are very happy that prices has gone down, and they are anticipating the price is going to go up, the consumer. So they would be very happy to enter into a futures contract to lock in this lesser price. But there may not be a counterparty who is willing to take a position. No hedger may be willing to take a position. So you will have a speculator who is willing to take risk and be a counterparty position to these long hedgers. Similarly, let us say commodity price has increased significantly. It has gone up very high, and producer and sellers of the commodity would like to lock in this high price by entering into a short futures contract. At that point of time, they may not get enough number of hedgers as counterparty. So who fills in at this point of time? Speculators who are willing to take a risk for getting a benefit. So in that case, so there could be situation when you have the presence of speculator is mandatory, or otherwise there will not much of a trading volume. There may be long futures orders must be coming, or short futures orders must be coming to the exchange platform, but there may not be, order matching may not happen because there are not enough counterparty to take the counterparty position. So with this we come to an end of this session. So okay, one thing I would like to also share here, exchanges at times permit or allow a larger amount of maximum permissible open position if they are hedger. So NCDEX, this particular slide. So this link of NCDEX shows what are the amount of limit allocated to different hedgers. So this is a report which is published on 20th May 2016. So this is for different, if you can see, soybean to ITC, ABD. So they have allowed 120,000 tons of open positions can be taken by ITC at a given point of time. So with this we end up this session. However, last couple of sessions there are certain key takeaways. It's mentioned in this particular slide. So these are the key takeaway from the last couple of sessions. So what is the role of a clearing house, what is novation, how value at risk can be calculated, and how an exchange decide what should be the quality specification for an underlying commodity, how exchange decide the limit for maximum allowable open position, who is a speculator, what is short squeeze, and also I'm going to end this session with one question, that is whether you would prefer commodity exchanges to have underlying commodity exchanges to offer contracts, commodity option contracts to have futures contracts as underlying or commodities as underlying. So thank you all of you, looking forward to meeting you all, interacting with you all in the next session.